Well, just for everyone joining now, we're going to wait a few minutes for give a chance for the rest of the people to join. We have a lot of people signed up for this really interesting, I'm excited about it webinar. So just a few more minutes. We're also recording it and we'll share it afterward, I assume, with your guys, with your audience, with our audience. So everyone gets the ability to learn more about infinite banking and life insurance, whole life insurance specifically, which is, and I'm going to give you guys some hard questions because I have a lot of questions. So I'm sure you guys are used to them.
Yeah. Well, so I think the easiest part about this is figuring out the process. The hard part is trying to figure out all the details. And Joey and I got to spend about 10 years with the guy who wrote the book before he passed. And he would commonly say to us, if they don't get the concept, the details won't matter. And I think that too oftentimes we miss the concept. We get so hung up in the weeds because that's the way we've been taught with traditional investing, is to try to nitpick into certain areas. And so our brain thinks one specific way. So hopefully we'll do a decent job of shining light over the whole concept. And then that'll allow for the questions maybe to be wrapped in light of that. Because if you start detail wise, you'll probably miss the forest for the trees.
Yeah. All right, let's kick it off. Basically, the agenda is we're going to give some intros, like who we are. Russ and Joe are going to give an intro about who they are. Then we're going to dive into the weeds of it, and we're going to leave a lot of time for questions. Like I mentioned, I have a bunch of them for you guys. So I don't know, why don't you guys start giving background about you guys, like keep it short because I'm sure you're going to keep it in the details when you just talk about specifics.
Sure. Well, I'll get us started. And, my background, Latan, I'm not sure if you're familiar, but I was in the mortgage business for 11 years. And I had kind of gotten accustomed to this idea that your active income, if your income was increasing, that created freedom, right? That created financial success. And as I found myself in my late 20s, making over $300,000 in the mortgage business, it didn't feel like success. And, and by anybody else's standards, it looked like it was successful. But to me, it wasn't, because I have 5 daughters and I was constantly being pulled away from them because the responsibility for that income came with always being available on the phone, returning calls, working 50, 60, 70 hours a week. Some weekends I was getting audited by my own company. The bank was so regulated. I had to be available for these audits that, tons and tons of pressure. I actually got physically sick through this process, but I thought, there's no other way. This is the way the traditional, world tells you is success is, go to school, get a good job, put money in retirement, and one day you get to have this freedom called retirement. And it was about that time, about 7 or 8 years into that, Russ and I had been friends, and he introduced me to a book. And he said, hey, by the way, this is what I'm teaching all my clients, and I'd love for you to read it because I want to refer you some business in the mortgage business. I'm like, sweet. I mean, who doesn't want referrals, right? As I read the book, it's like all these light bulbs start going off in my head. It's like, man, all these questions I had about why am I putting money in 401ks when those things, I don't understand it, what it's being invested in. I don't have any control over it. It's going up and down. I mean, this is right at tail end of 2008, by the way, 2009. So you can imagine I'm just reeling from losses in the market. And the book is all about control. It's all about taking an active look at your finances and becoming the bank, being that person that's making the call.
But hold on, just what's the name of the book that he gave you?
Becoming Your Own Banker by Nelson Nash. So that's the author Russ was talking about, is that we got to meet Nelson, spend 10 years with him before he passed. And the long story short, I start implementing the same process that we're going to talk to you guys about today. And within 4 years, I'm so convinced and compelled that I leave that career cold turkey, and I joined Russ in helping to get the word out. Wealth Without Wall Street was formed a couple years after that. So this was about 2016. And that's where we now have started to look back and say, man, all the things that we went through, we've just now systematized and allowed people to join us with our own coaching process to implement what you're going to hear today, along with getting into passive income investing, creating true financial freedom.
Awesome. Russ, what's your background?
I'm gonna show pictures. Is that okay? Because listening to a couple of slow talkers like us sometimes way too hard without pictures. So I'm gonna show pictures.
You don't dive into just your background, right? Just your background.
Yeah. I like to let people know where I come from, right? So one, the idea that he was talking about. So I was a kind of an advisor. I was a certified financial planner. My wife and I, highly educated. So my wife was a dentist, and all the things that he was talking about Wall Street, I was participating in both personally, but also professionally. I was teaching other people about what to do. And it happened when, the market crashed in 2000 and, started in 2007, but you saw it really in 2008, when the Dow, that was the time I remember I was on a golf course the time, and my buddy had a BlackBerry and he says, dude, the Dow just dumped like over 800 points today. Now in today's market, like everybody would be like, okay, so what? It's a Thursday. But then that didn't happen. Like it didn't move up or down more than like 10 or 15 points in a day, at least for the previous 4.5, 5 years that I had been an advisor. So when it did that, like it shook me, man. I was like super scared about what had happened. I was thinking about all these people that I'd personally been advising, right? I was an investment advisor. So they'd give me this money and trusted me. And I was just following all the things I'd been trained to do. But here's where it really got scary, is that when I went to my mentors, the people that we would seek out to like help us with portfolio allocations and discussions around different strategies, I went to them and I asked this one question: what will keep it from happening again? And they didn't have an answer, man. They had no answers. Like they equally, I could tell on their face, were super concerned. Now, you fast forward 9 months later, 12 months later, they've built their own strategies. They figured out how, if they would have done this, it would have not happened again. But that was just really, just looking in the rearview mirror and planning for it wouldn't happen that specific way again. But I just knew for me, like that was not the confidence I wanted. And I was the one responsible to go share ideas with Joey and other people of how it wouldn't happen again. I didn't have an answer. So I went and sat at a conference and figured this stuff out. And we'll kind of talk about what that is. But for me, it first started with, I knew I needed to understand what financial freedom really looked like. And it wasn't having 7 figures in a bank account and trying to roll off 3 to 4% a year. It was more about this, which was having more passive income than we had monthly expenses.
That's awesome. All right. So if you're already with the presentation, I'll give some pictures of my own now, just to give my own background, and then we're going to dive into the weeds of it. Not going to waste everyone's time, just because we're not that interesting, the three of us. More interesting, like what we do. So also just quickly dive in, and this is something am I in the wrong? There. Can you guys see you can see the slideshow here, right? Keeping passive.
Yeah.
Passive. All right, cool. So just quick background. So I'm Litan. I'm the co-founder and CEO of Vyzer, and my background is I'm ex-Navy. Israel on all the news now. Yes, I live in Israel, currently actually in the States, but I'm from Israel. A big part of our team is also in Israel. So my background, I served in the Israeli Navy for 6 years. After that, went to school and founded a company that built machines that do this. We did 3D imagery of diamonds. Crazy world, crazy story. But long story short, we sold this business, had a successful exit in 2015, and then dove into investing in a lot of private equity, real estate stuff in the US and Europe. And that's sort of when we got this, good problems of managing all that stuff, right? We had, multiple investments in different private equity firms, real estate. We didn't get into in life insurance yet. Probably will, but we haven't gotten into it yet. And that just created these big problems, and that's why we built Vyzer. And Vyzer essentially is for like people like us to keep passive investing passive. And so that was our objective. And just I'm like, if we want to talk about life, so I didn't want this because I did have a few like investment properties at the beginning, and I wanted more of this, right? More of the time that Joey, when you were mentioning like with the family, creating experiences, traveling. And so that's our objective, is to keep passive investing passive. And if we can leverage life insurance to do that even more, that's what this whole webinar is about. All right. So we're going to dive into it. I'm going to hand it over to you guys. And just one more point, like we sort of, I feel like full closure here, because about 6 years ago, before we started, having big portfolios, I found you guys, your podcast, the Well Without Wall Street podcast. And I guess it was relatively new at that point, 5-6 years ago. And I was blown away. So I've been following you guys for years. I love the journey the journey and company you guys have built. And I'm super excited to dive in and ask you those difficult questions about life insurance. So I'm gonna hand it back to you. And just for all of our attendees, feel free, drop off questions in the Q&A at the bottom. I promise to leave a lot of time at the end. And I hope there's gonna be a lot of questions during that time. So Joey, Russ, try to keep it, 25, 30 minutes max. And then when we're done with that, we'll dive over to questions. Fair enough? Make sense?
Perfect.
Absolutely.
All right, guys, let's do it.
All right, Joey, I'm gonna I'll start her up and let you take off. Let me make sure I got all the buttons pushed. All right.
All right. Well, so in order for you to understand infinite banking the best way possible, this is how Russ and I learned, is pictures and stories. And the most important one is a case study, right? How is this being used successfully? And in order to actually get to that point, the foundation is, in order to become financially free, you have to have passive income that exceeds your monthly expenses. So in order to get that passive income, you have to actually have cash, right? And to get access to that cash, you need to learn what to do. And so that's really the basis of today, is let's talk about where's the best place to park cash in light of creating passive income. And the case study we're going to talk about today is actually utilizing the insights that we've created in building a land flipping business, a 7-figure land flipping business. Now, if you're familiar with land flipping, give me a yes in the chat, and I'm going to try to keep a good watch on this. Okay. If you're not familiar with land flipping, give me a no. It sounds like maybe there's a lot of no's.
So there's a chat
land flipping,
and there's a Q&A. There are two different things here, just for you guys to know. There's the Q&A. I saw someone answered it in the Q. I also want to one of the things I thought maybe we do, just before you kick off, we can do a poll here. Now we can ask that in a poll, right? And then it's an easier one.
Okay.
You want to ask what? Are you familiar with land flipping?
With land flipping.
All right, let's see what happens here. This is the first from me.
I think this is it's important. Like, the reason if you mentioned the time following us on the podcast, every month we show our passive income report, right? So we show where that we're personally investing and the results, right? Both positive and negatives we share it every single month, and have going back to June, July of 2020. And land flipping is one of those that we use a lot, and people end up asking us a lot of questions about it. So we thought, hey, well, let's use this as an example, because it's one of the older ones that we've been using, so we can kind of show some numbers behind it. And so there's a interesting stuff. So are you familiar with it? Yes.
All right. So we have So basically 50, there's actually a majority of people who don't know. Well, now it's 50-50.
Okay.
All right. So anyway,
well, I'll give you the 30-second overview. We have been taught by the land geek himself how to go and purchase property, raw land, from existing sellers who do not want that land at 20 to 30 cents on the dollar. Take that land and then turn around and sell it on terms to a retail buyer at the full retail cost. So you're talking anywhere from 75, 100 to 300% returns based on this model. if you do that over and over and over again, you create a note income that people are paying you sometimes 5, 6, 7, 8 to 10 years for that piece of property. And so it just creates this ongoing increased kind of way that you're seeing passive income come in. That's what this land flipping business is all about. And so with that, I'll kind of dive in to the 3 big ideas behind this today. First, we're going to, in order to have access to cash, we have to learn or unlearn certain things that we've always thought to be true. And I'll let you kind of determine as we go what that might be. There's obstacles standing in your way. And for me, I had to unlearn quite a bit. So maybe you're in the same boat. You also need to build a warehouse for your money to reside. And how big of a warehouse do you want to hold your cash? It really depends on what you're trying to accomplish. And then once you gain access to that cash, you then start to stack the passive income over and over again. And this is a quote that one of our health coaches actually taught us, but it's applicable here. We don't rise to the level of our goals, we fall to the level of our systems. And so that's the issue today, is that we want to create a system that is actually going to get us to our goals. So as I mentioned, we love our kids. So Russ has three daughters and a son. This is not his son. It is actually a stock photo, but it looks similar to his son. But our kids all love using Legos. I mean, if you guys like Legos, give me a yes in the chat, because I know I'm a big fan.
I think the chat may be disabled too. I don't know if you guys have had a chance to fix that, but
I was
getting a message like the chat's disabled. You can't do it.
Yeah. All right, we got some Lego fans in the chat. All right, cool, good. I'm just glad we're not alone. So the first couple of things is, as Russ mentioned before, passive income being greater than your monthly expenses equals financial freedom. And just in case those are just words, let's make it really personal for a second. If you tomorrow, you woke up and there was more money just sitting in your mailbox than what your actual expenses were this month, and it did not require you to go to work to create it, what would your calendar look like right now? Right? If you pulled up on your computer, your calendar, it would be blank, right? There'd be nothing on there, and it would be you who would then be putting those blocks on there as to how you're going to spend your time. That is the picture of financial freedom, and it only happens when your passive income exceeds your monthly expenses. Now, based on that, every decision that we make, this is like going to simplify life, okay? Because Wall Street wants you to think that it's really complex, that you can't do it alone, and that you're not smart enough. But if you really think about this formula, there's not a whole lot to it. Either what I do with money has to increase my passive income or create a passive income, or I'm going to reduce a monthly expense. If what I'm doing with money does not do one of those two things, it is not getting me closer to financial freedom. In fact, it's getting me further away. Okay, so to make this simple,
so Joey, let me give an example. Like whenever I met you, what was the thing that you were putting the most money in?
Oh, 401k for sure.
I think most of us probably would relate to that putting money in our 401k or our company qualified plan. I don't know if they have something similar in Israel at the time, but that was like, for us, that's where people put money. And so when we were like having to learn what, as Joey said, in order for us to build passive income, we had to first get access to our cash, but then we had to either learn or unlearn all of these things. One of the first things that the man Nelson Nash, who wrote the book Becoming Your Own Banker, you were wondering, like, why are we going through this process? Because this is the part we had to learn. He was like, let's talk about qualified retirement plans. Let's talk about what you're doing with money. So if you've been putting money into a qualified retirement plan, like a 401k or a Roth IRA or whatever it may be, SEP IRA, then here's the question. Does that 401k, is it currently bringing in a passive income for you? Yes or no? Just really quickly in the chat. No. Yeah, it's not, it doesn't produce passive income. Okay, so the other end of that formula of passive income, that it didn't do that. Well, then is it reducing a monthly expense? Yes or no? Put that in chat. No. So then the question
Also,
Joey's asking is it getting you closer to or further from financial freedom? Just based upon that simple analogy, like being able to use that framework and apply it, is it getting you closer to or is it getting you further from? Yeah, it's getting us further from. What's another example, Joey?
so the second thing that I was doing is I was paying extra on all my debts. I was trying to stay debt free, as all the financial gurus out there talk about. And so I stopped. I look at this same framework that Russ has just laid out for you. And I asked the same question by making extra payments. So think about this. Let's say I doubled up on my mortgage payments, or I paid a 15-year mortgage instead of a 30-year mortgage, or I paid extra on that student loan debt or the car loan or whatever. Answer for me this: by making an extra payment on my mortgage, did I increase my passive income? Give me a yes or no in the chat. No. Did I, again, now using the mortgage as an example, I didn't pay off the mortgage. I was just paying extra towards the debt every single month. Did I reduce my monthly expenses in that transaction? No. In fact, I increased my monthly expense because I was paying extra. So then the real question comes again: did that action get me further or closer to financial freedom or further from?
Yeah.
Further from. Exactly.
And we could apply this to the stock market at the time, where people put money in the stock market all the time and they're saying, hey, yeah, I know that I'm not, I'm growth oriented. I'm not getting any passive income. It's taking money out of my pocket. So I'm not reducing my monthly expenses. So again, the same thing's happening where I'm getting further from. So that's one big area for us that we had to both learn and unlearn a couple of things. And maybe that's helpful for you. Joey, there's other things, though, being from the mortgage business, that you had to learn and unlearn.
Well, imagine this. Russ challenged me with this quote. He said, you finance everything that you buy. And I'm like, Russ, you're wrong. Okay, I got you on that. You're telling me all these other things. Okay, I buy that. I don't buy this. I know there are people that go into debt and then repay it, right? I mean, I actually teach people this every day in the mortgage business. So they borrow and then they repay. And I was very familiar with that process. But I was the guy that was paying cash for everything, right? I don't borrow for cars. I pay cash. I don't borrow for vacations or whatever the case may be. I always pay cash. So I don't actually finance those things. And he showed me the same graph and he said, actually, you save up and you dump it out. You save up and you dump it out. And in actuality, aren't you really just chasing zero? And I was like, wow, that really impacted me, because the idea that I wasn't that much farther ahead than the person who was borrowing first. I had this kind of pride complex that I was better than that person. But in actuality, I was giving up the very thing that most people say they all want, and that's compound interest, right? And
well, the point I think I want to make sure that we don't miss this. This is easily missed here, Latan, is that we see the interest that we pay all the time on everything that's financed. And this is a big component of why infinite banking makes sense. And this is why we go through this and take extra time, is to say we pay interest. We see that all the time. But we're so taught this model of paying cash that we forget and don't see the bill that comes in the mail for the opportunity cost that's lost, right? Because when we pay cash for something, we give up what that money could have earned for us. Now, some of you are getting that immediately. But if you're slow like me, you have to see it in numbers. You're like, exactly. I'm not going to take your word for it. I want to actually see this thing play out. So here's like a numerical example where you can see we're using land flipping. So any of the land investors in here, they're interest rate snobs. And I say that with the highest regard, meaning that they will not do a deal unless it earns 72% minimum. If it doesn't do 72% yield, they don't do it. Now, most of us are like, wait a second, I'll take all of your scraps, right? I'll do every deal down to 25, 20%. I'll do all those deals. So when I created this example, I think of the advanced investors, right? People who get 20, 25, 30% in their sleep. And our land investors are like, well, I get 72% or I don't do the deal. So I want to show this is that if you started an investment business and you just put 25 grand in, right? Hypothetical scenario, forget all the other things that can happen. Just use this math that over 25 years, if it earned 20%, you never took a dollar out of it, you end up with 2.3 million, right? So I want to show you the power of paying cash and what that cost truly is, because nobody ever shows us that receipt. So here's an example, Joey. When I met Joey, he was driving a Toyota. What was it, Joey? It's not a Camry.
Avalon.
It was an Avalon.
Dude,
and
it's like
it roughly it cost
Toyota Lexus. Yeah.
99% of all the grandmoms who were driving the Avalon, it cost them at that time about 20 grand. Okay. I don't know what it cost Joey. They probably charged him extra because he was taking one for the team there. So if Joey took, if this was Joey's business, he took 20 grand out of his investment business that had been earning 20%, says, I'm just going to take this, I'm pay cash, just like the Dave Ramsey and the other gurus in the world that tells us not to, use financing. Let's look and see what the expense is of that scenario. You notice down at the bottom that we end up with $1.4 million, right? So the expense of using cash cost us $920,000 for that one transaction. And the thing that we always think about is how many transactions are we making? How many major purchases are we making throughout our life where we're using cash and we don't get to see that $920,000? Nobody sends us the bill like you get in the mail every time your mortgage payment. You get to see the interest associated with that payment that you just made.
Russ, hold on a second. Sorry, I want to interrupt you, but I have two important questions here. So there are two assumptions that we're assuming, right? And this is all about leveraging versus not leveraging, right? And we're taught that this is bad. I think, if someone has cash in their bank account, hundreds of thousands of dollars in their bank, all right, they're not doing anything with it. They're not investing it. They're not doing anything. It doesn't matter what the interest rates are. That person should not take debt because they have cash they're not even using, right? So that's important. That's point number one. Point number two, so if you're not going to go into the work to find the place to deploy the capital, then all this, all right, if you're lazy, you're going to stay lazy. So don't take debt, right? The second part is the rates, the interest rate and the rate of return that you're talking about, right? That's an important point, right? You're showing 20%. And I'm sure people like moving in their seats. Well, holy crap, 20% annual return. Like I'll pay for 15. Give me 10. Like it's like, so that sort of seems a little high. And also on the flip side, the interest rates, the loans, the interest rate paying on a loan is also really high. And so I think it's also important to emphasize there should be a spread, like a healthy spread between that and the potential return. I'm not saying it's wrong. I'm just saying that I'm sure people like moving in their seats now. I say, wait, this is nice, like in a beautiful, sunny day. But when it starts to rain, this specific, table, does it work?
So this, and maybe I poorly explained this. So this is just the example, not of paying interest, right? Like borrowing money. This is just paying cash. This is taking cash out of an account that was earning 20%. Now, to your point, if you're not an experienced investor, you're probably not earning 20%. If you're an experienced investor, you're like, I don't even get out of bed for 20%. So it depends on who we're talking to. And I'm not trying to, again, your scenario, this is generic enough to where if the number is $1.50, we're not having a conversation because it's not interesting. Right. But it's intended for us to see the expense that is associated with what the loss is. So if we did 10%, that number would be less. If I did the 72% that my land investors normally get, this number would be astronomically large.
No, overall, we're talking about compounded interest. It doesn't matter what the rate is. If you take the cash out of it and stops compounding at an early stage after 5 years, that's going to have a huge effect 20 years from now because of the compounded interest that I lost. That's basically
exactly.
Yeah,
but a lot of people, Latan, to Russ's point, they will say things like opportunity cost. But in order to understand what the actual cost of opportunity cost is, this is what we wanted to give at least some way to tangibly like put it in number format, because otherwise it's just a concept. It doesn't really affect me.
Right. I see where you're going with this. I get. I think I know where this is going. All right.
Well, we share this because there's a couple of things that we have to learn and unlearn, and one is, yeah, what is the cost when we pay cash? We have to know that there is a cost, and now the cost is not always this expensive for sure, but there is a cost, and that cost is never really identified and never talked about. And so our point is to say that. Well, to your point though, you were saying we need to know if we're going to borrow money that there's an expense, and not everybody should be borrowing money and doing investing. So we're not a fan of that. But one of the things I think that we've learned, and I used to tell people this, is that debt freedom equaled financial freedom, right? Being debt free was financial free. And most of us, if you've read the Purple Bible, Robert Kiyosaki's Rich Dad Poor Dad, let me know. Give me a 1 in the chat that you guys have ever read that book or any of the other books that Robert's written. All right, perfect. So for everybody else, you have an opportunity, but this is Robert talking on a podcast, and he's really addressing this concept of debt freedom, right? Being financial freedom. And so let's see what he says.
Check this stuff out. I am a billionaire in debt. You know why? Because I get tax breaks for borrowing money. And the reason I am so rich is because I'm in debt. And my friend Dave Ramsey says, live debt free. Well, you're an idiot.
So there's Robert being very blunt about a concept of, does debt freedom equal financial freedom? And he's not advocating that we just go borrow money for the sake of borrowing money. I don't think he would say go borrow money to buy a boat, to buy a motorcycle, or to go on a vacation, right? What he's saying though is that if you, to your point, Latan, is that if you will do the due diligence, if you will become a better investor, because there's no good about investments, it's just good about investors. If you become a better investor, then you will know how to outperform the debt that you borrow in that scenario. So in this example, I'm saying 20%. If my ability is only to be able to outperform 5%, then anything that's 5% or less, then I should not borrow money for, right? If my ability is 15%, then I should do deals only up to 15% and pay cash for everything else. Kiyosaki is clearly probably a much more skilled investor than most of us on this call. And so he may do deals that would be higher than that. I have a client that they were a home builder, and they grew their business in 2010, 2011 by borrowing money at 21%. Did it work out for them? Yes. They sold their company for about $50 million 3 years ago to one of Warren Buffett's subsidiaries. It worked out for them, borrowing money at 20-something percent, because they could out earn it. Not all of us are there. So just one idea.
Check this stuff.
Not the end of everything, but just part of it to say we need to understand. And all of this, for those who are new on this conversation, was all identified by the man we were talking about earlier, Nelson Nash, when he wrote this book, Becoming Your Own Banker. And to me, it's the one that helps us understand the concept the most. And he talks about, all the different things that are going on with infinite banking, what happens with the life insurance policies, how the policies grow without taxation. He goes through all of these different details. But for me, the reason why it was so important, I was sitting at a conference the time down in Orlando, Florida in 2009, 2010, and he's sitting there sharing this conversation, and I'd heard him speak the previous 4 years, and because of my professional kind of background, I'd always been taught that using life insurance was the worst place you could put money, right? Like maybe the ladies that Joey stole the car out from under, that was good for them, right? Like, in the 70s and 80s, that's a good strategy for them to use life insurance, but not for investors like us, right? People are going to use money. And I'd always turned it down, but it wasn't until that market had crashed where I was open. I was sitting there listening. So I bought his book. I'm flying home from Orlando. I'm reading the book. I turn the book over, and the last thing I see is this. He gives his address. And if you notice there, if you can see that, it's Birmingham, Alabama. That's where I live. I live in Birmingham. And I'm like, wait a second, this guy's in Birmingham? So I made it my mission to make this guy the guy I was going to seek out and ask all these questions. And thankfully, he literally, that was his phone number. Up until he died, he would have answered that call. If you called that number, he would have been the one who was answering the phone. This is an economist. And so I spent a lot of time, and then Joey ended up spending a lot of time with me with him. And we asked him a lot of questions. But one of the things that I had to learn about this whole concept is how to use life insurance. And it was a different type of life insurance than I'd been taught through my professional upbringing. It had nothing to do with term insurance, had nothing to do with putting as little money in and getting as much money of death benefit. It was actually the opposite at the time. Like the concept of using infinite banking is not a one size fits all. So I can't tell you as a percentage how much money you should put in, how much money should go to this specific area versus this area. But the general overview is that we want as much cash going into the life insurance policy and as little death benefit as we can get to avoid some of the rules that in the US, the IRS puts as regulations, saying if you put more cash in than this, then we're going to treat this as a taxable event. We're going to treat this very similarly to a 401k. And what he talks about in that book, Become Your Own Banker, is that if you will use this instrument, and he's called it a bank, like if you're going to store cash in this system, here's all the benefits you're going to get. You're going to get guaranteed growth. That growth is going to avoid taxation because the IRS specifically has stated that in its tax code in 7702. It's going to be in different states creditor protected 100%, and most of them, and a few of them that a little bit less than that. It's going to grow without taxes, but more importantly, going back to what we were talking about a second ago, and you identified it, it's going to grow uninterrupted. That compounding curve is going to grow uninterrupted. Now, by the way, this is life insurance, and so it really pisses this guy off, okay? Dave Ramsey hates it when people talk about life insurance. He'll tell you it's the worst investment ever. You should never do it. And you've heard the strategy that, success leaves clues, right? Just watch what other people are doing are successful. Well, this is a list. I pulled this June 30th of this year in the U.S. This is the top 24 banks in the U.S. And they have with at least $1 billion in cash value life insurance. So when people ask me, Russ, why would you do such a stupid idea? I go, well, I don't have to be smarter than the smartest people out there. Do you think the people at these 24 banks have done their research? Do they understand money, maybe at a little bit higher level than you and me? Is it possible that maybe there's a different way they're using it than the way we've been taught? And that's what really started my process of having to unlearn the things that I'd been doing and learning some of the stuff that I needed to learn.
So just to recap, the things we unlearned or needed to unlearn was contributing to 401ks, financing everything that we buy. In other words, there's a true cost of capital when we pay cash. There's debt freedom doesn't equal financial freedom. And contrary to Dave Ramsey, whole life is a great place to store cash. Just look at the top banks in the world. Now, we said the second part of this is to build. And once we learn what to do and what not to do to get access to our money, then we can start building the warehouse for it. So we've kind of gone through this. I stopped doing these things, right? Stopped contributing to 401k. I had a Roth. I quit putting money in there. I quit paying extra payments. I got rid of my term insurance because I replaced it with like 3 times the amount of whole life that I had. And my savings account became the new location was in my system of policies. So that's kind of the first steps that took place. Now, Russ has an actual illustration here of his system, and I'll let him kind of download that with you.
Let's just try to get just try to get into details because there's going to be some questions here, right? We have
so this is where I want us to start getting into the meat, right? This is where people start to say, well, just show me the numbers, right? And I want to show you the numbers. And I think the easiest way is not to show you a hypothetical, but to show you like my own personal scenario. So I don't know if you can see at the very top of the page, it actually shows when I bought this policy, and that's January of 2010. And so if any of you are looking at the numbers, how much money I'm putting in, don't make fun of me. Okay. This is just my first policy I started. I have 28 policies now. So, but this is my first one. This is all I've taken all of those things that I stopped doing, and I could come up with $25,000 a year to put into this. And if you look over on the right side, you see that the death benefit, because that's what usually people think of, life insurance, death benefit, $992,000. Now I'm gonna make the numbers bigger so that way you don't have to squint and try to read it. So I just took those numbers, put it on a simple spreadsheet. And so here's how much I was putting in. Here's how much the cash value was each year as I was putting that money in. And you can see how much money I personally paid. So whenever we look at this, we want to see those are the three things we think about: how much we're putting in, what's the cash value, what's some of those other benefits. But I really want to like illustrate it maybe a little more visually, because the question I had immediately, and it's funny, we're about to do a podcast on this later today that'll air in a couple of weeks, is the question I asked is, well, could I just use a savings account? Like, couldn't I use a money market account? Wouldn't that make more sense? Wouldn't that be simpler? I don't have to buy all that insurance that I don't believe in, or that I think I can get cheaper with term insurance. And so I was like, well, let's take this example, this real life example. These are the numbers, like, because this is my actual results I'm showing you on this page for the last, whatever that is, 13, 14 years. That's what's happened. I want to show you what really was transpiring and kind of give you an example. So in the chat, if you would, show me if I put this, in a savings account, right? That would be my liquid alternative, because that's all we're showing. So I want you to see this. If the black represents where I could have put it, which is like a savings account, that's how much money I put in, because for the most part, we haven't earned any real interest in our checking or savings accounts. You would see in the first 3 years that my savings checking account would have had a lot more money in it than my life insurance policy, right, Latan?
Yep.
Now, the normal question is that if I'm your buddy and I come to you and I say, Latan, I'm putting money in this life insurance policy, and you're like, well, couldn't you put it in a checking or savings account? I say, yeah. And you say, well, what's the difference? And I showed you those numbers. What's your likely comment to me? Am I making good decisions or bad decisions, in your opinion, just based upon this limited information?
I think you're making bad decisions.
Yeah, this is where I shut my brain off. Like when I heard Nelson Nash speak in 2005, 2006, 2007, 2008, I'd flown all these different conferences, and he was at that as a small keynote speaking. And I was like, I would get about this far into the process, and I'm like, the math doesn't make sense. I don't want to do that. I didn't realize all the things that start to happen after the fact, right? Anything that we're building, the businesses, when you built Vyzer, were you expecting an amazing profit in the first year?
No.
The first 3 years.
No, but the alternative is different, right? So there's I wouldn't compare the two. Like, this is you're depositing cash into an account, and what's the alternative of depositing that cash? That's the alternative.
That's the alternative, right? But the point is that we make different decisions in life, and we think of them differently when we get into investing. And that's why I believe, the human behavioral economics will tell us that we will make bad decisions that aren't always in our best interest based upon others' mentalities and the way they look at money. And that's the way I would have done this too. I would have said, my alternative is this is better. Well, again, these are real numbers. This is the exact scenario. You noticed in 2013, my cash value that year grew at a greater rate than what I would have had I just put in a checking account. Now, right. You notice down here is that the numbers really start to get significantly different. Like in 2018, the amount of growth I had in that life insurance policy was twice what I put in premium. Now, we were talking about land investing today as an option, but you can replace it for syndications of real estate, ATMs, whether or not you want to do e-commerce, you're investing in your business. It doesn't matter what you're doing. If you've got twice the money to do it with, are you going to get closer to or further from financial freedom in that process? Now, I had to make up for early years where I was behind. But if this process keeps going on, you can tell that I'm going to catch up pretty quickly. And so when I show, I like to look at these numbers. I like to see what was actually happening. But then the real result to infinite banking is somewhat in the tool and the cash values, but the other part is what you actually do with it.
Right. So hold on, before we dive into number 3, because like we have 13 minutes more to this chat and to this webinar, and I do want to leave time for questions. Do you want to summarize the stack, or is that like quick? Or
yeah? So here's let me say this is the biggest key, is that when, to your point, that yellow line represents our cash value. What happens differently in the life insurance policy is that we don't actually withdraw the money, we borrow against it. So we borrow the insurance company's money. So every deal that Joey and I have done to this point, we've always used that cash value. And this is an example of what we did with it. So we took our cash value and we started investing, and these are the numbers in here. So we're in a partnership. So Joey and I, unfortunately, don't have 100% partnership in this deal. We only have 70%. So if somebody took their calculator out and took 70% of this 1.6 million, it'd be roughly 1.1 and some change. And I'll show you kind of what's the math. So here's how much money we put in the deal. So we borrowed $100,000 4 different times and put it into that deal. And somebody says, all right, well, the math on that deal is 400,000 over that 3-year period of time at 1.1 million is 41%. Not bad, right? But that's not the math, because if I take you back to that curve, we didn't use our money, Latan. Whose money did we use?
your banks.
We used the insurance company money,
yeah.
Right? So the only thing that we were responsible for in that deal was the interest on the 100,000 that we were borrowing, because our 100,000 was still in the insurance contract, still earning interest. So if we were paying 5%, I simplified the math here. It was actually a little less early on, but the math is that I would have had about a $45,000 expense. So if I take that, I put it in a financial calculator, you see that $45,000 of interest expense with the 1.1 present value, what's my return? It's 327,000. So that's when we talk about leverage, we know that as investors, we're looking for leverage, but how do we use infinite banking to do that specific thing? The same thing applies. The difference is the borrowing who comes from the insurance company comes with a lot less restrictions, a lot less issues. And I'm sure that's probably where the questions will start to go. But I figured that would be just a decent visual to see of how we put all this together. And our job is ultimately to try to figure out how to keep our passive investing passive. And so we use a system that makes it autopilot.
And by the way, this is a shameless plug for you, Latan. Russ showed you the 100,000 that we put in for those 3 years. And as we were literally entering in this entity, this land business into Vyzer, we recognized we haven't made a $100,000 deposit into the land business this year. And so it prompted us like, oh, what are we doing? We should be investing more into this. It's doing really well. Why would we not? And it was because we were actually stopping to put money or put all of our stuff into Vyzer. So anyways,
you say that we keep up with stuff on spreadsheets. Well, I can show you the spreadsheet that we've been keeping up with all this stuff. Yeah. And I just had not looked at it until we were like, I was trying to enter it into the black box and do all this stuff. And I was like, wait a second. Maybe we've been putting in money this year.
All right. So listen, that was a really great rundown. I'm sure we could have spent another hour talking about life insurance and infinite banking. And just like a note on that. So when we met again, like a few months ago, we built out our whole life insurance tracking capabilities at Vyzer, only because we had a lot of clients starting to use it and asked about it. And because you guys in your community started to use it and also wanted it. And so yeah, that's such an important point that it does help you stay on top of it and also miss those stuff. All right. So questions. There's the first question here is, where do you guys find the land? Let's leave that to the end, because I want to dive into the first insurance questions.
Sure.
So this is a long one. Does the insurer have the right to change the interest rate on loans? If so, will the interest rate change on an existing loan that is repaid over several years between the date on the loan is taken and the date is repaid? Does your full cash value earn interest, or do you only earn it? So you get the question. I'm sure you guys get this, that you get asked a lot.
Yeah. So great question. I mean, ultimately, when we're talking about loans, we're talking about what are the terms, right, around the loan. So within that, we're going to have many different things. We're going to have what's the rate, what's the structure, meaning is it amortized, is it interest only, is it, do I not have to make payments to it, right? Do I have to fill out paperwork? Does it affect my credit score? All these things, because that's our traditional way. Like Joey was an expert, right? He'd do 300 loans a year plus. He knew that those are all the things. So those are all the questions that he asked me. So the way the life insurance policy and the loans against the cash values in them work is one, here's the questions. How much money do you want? And where do you want me to send it? Those are the two questions. You cannot borrow against the insurance company's money for more than what you have. So if I have $100,000 in cash value and I want 500,000, they're going to say, good. We'll give you up to about 98,000 of the 100 you have in there. You got to go find the other on your own, right? So they're not going to overextend. That's one of the reasons why they're safe. The second thing is that they're going to start calculating interest. Every single insurance company has it designated exactly how they calculate interest, whether it's variable or fixed. And those terms are not associated with the same ways that we typically see rates move. They're not associated with LIBOR, they're not associated with prime. So interest rates will move really slow. Insurance companies are working over a long 100-year period of time as compared to our banks that are working in quarters, right? So they will dictate exactly what the interest rate is. We are owners of the insurance company because we buy only mutual life insurance companies, which means the policyholders are owners. So any growth, any profit that the insurance company make comes back to the owner. So we're a recipient of it. So when interest rates are higher, our dividends, our returns will be higher. So typically we'll see loan rates may increase over time when rates are higher. They'll come down when loan rates are different. The biggest thing that I think that most people who are investors like us really appreciate is that we can get access to the money anytime we want. We don't have to have a bunch of Mickey Mouse paperwork, but also there's no required repayment, meaning we do not have to make a payment back. There's no monthly coupon that you get in the mail that says pay $482.62 back. There's no coming back and repo in your investment that you made. We literally accrue that interest and we make payments based upon our schedule. And obviously we encourage people to pay it back the way that they would have paid it back otherwise. But there's reasons why as investors, sometimes we invest in deals that don't already start producing cash flow. And so it's nice to not have to go negative cash flow by borrowing money.
All right, let's take another question from Al. Is what is the dividend earned of the cash value insurance? Is that what you mentioned basically based on the interest rates, or that's something else?
So dividends are going to be a surplus that is paid every year. The companies that we work with, they've been in business for over 100 years. They've always paid a dividend. The dividend is not guaranteed, but it can fluctuate from year to year. So as far as the exact number, I'm not sure if that's what the question is, but it is paid on the entire amount of the cash value. So in the case where Russ gives the example, of $100,000 that you have in cash value, let's say you borrowed $70,000 against that $100,000 to go do whatever investment it may be or whatever, you're still earning off of the entire $100,000, although the 70 has been borrowed against. I don't know if that. I just want to make sure if that.
But there's not. But the dividend number, like, is there a percentage fixed that you're notified? This is the dividend you're going to get on an annual basis on your cash value, or does it fluctuate between institutions? I think that's more like the question here.
Yeah, so it does vary from institution. It's all a subject of profit, right? And essentially overpayment. That's why whenever you've given a dividend, it's not taxable to you because it is technically an overpayment is how they consider it.
What's the range? Is it like 1-2%? Is it 4-5%? Like, what's like the ballpark?
So we've seen it over the last 15 years that I've personally owned policies as low as like 4.4 and as high as like 5.8.
All right, cool. I think. That's helpful. Yeah. All right. So Kevin Easterly, if we pull out all the cash out of our policy, when they charge interest, does the interest come out of the death benefit?
Yes, yes, great question. The a loan against an insurance policy is actually the way you would define it is a prepayment of the death benefit. So
which
this
is
really
by the
good
way why
because,
they're willing to do it.
yeah, it reduces their an insurance company's liability is the death benefit. So when you borrow money, they're actually going to prepay you that death benefit by that. So you're reducing your death benefit by the amount that you've borrowed against. And as you make any repayments, then that continues to grow, or you make new premium payments to grow.
All right. So a few more questions here. How do you look? All right. I guess risk adjusted basis compared to other potential investments. So there's private equity. I don't think there's comparable, right? You don't compare this to the private investments. You compare.
It's not the investment. It's the place that you store the cash. So wherever you're storing cash right now to invest in any investment, fill in the blank, private equity or whatever, that's what you're comparing it to. You're not comparing it because you and I can go invest in the same exact deal and get the same exact return. The difference is your money will come from one place, my money will come from another. That's what we would then start to compare.
Yeah, the potential loss of that investment is does not matter where the money came from.
I do have a question on that point because I've read somewhere that what you showed in the table of like, all right, your premiums and then the cash value. Now it takes a longer time for the premiums to reach, like the cumulative amount of my payments to reach the total sum of my cash value. It takes a long time now. Is that wrong? Like, what's on average the time it takes to reach that sum?
So let me make sure I understand your question. So the amount of money I'm putting in every single year to when it equals how much I have in cash value. Is that what the question is?
Yes.
Yeah. So that curve
essentially the break-even point.
Yeah. Since I started that, it's gotten a little bit longer, but now as interest rates have risen, it's going to start to become shorter, right? So insurance companies they're buying bonds. They're buying 30-year bonds, right? That's the majority of their portfolio. So you think back, what's been happening over the last 15 years with interest rates? They've been going down, 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 right? So slowly those older bonds are being rolled off, the new bonds being bought. Well, the same thing's true now that we're starting to roll in new bonds at higher rates. So we have seen that time go a little bit out, but it's going to start compressing back a little bit.
How much is it? Is it still 5 years or 6 years or 10, 20 years?
That's so hard. I would say 5 to 10 years is a good measure because there's so many other factors that can adjust that number.
All right, guys.
It's not going to be past 10. Yeah.
So there are more questions here. I think we'll answer them all in an email, send it out to everyone, the answers to these questions. I apologize we didn't reach them. Next time we'll try and plan a longer webinar with these guys. I really appreciate it. I learned a lot. Anything you guys want to share, like the final notes?
I just kept waiting for you to stump us, Latan, and I appreciate you not doing that live. So.
I have a bunch of questions. Don't have time for it, all right? But I would.
Yeah, we'll send. I mean, I noticed that some people are asking, like, how do I really dig into this deeper? And so, one, you can listen to all the podcasts. You may be a DIYer. You may want to just listen to podcasts, go watch videos, maybe buy the book, Becoming Your Own Banker. There's a lot of other books, Build Your Warehouse of Wealth, The Case for IBC. There's a lot of things out there that you can go do. Some people want to jump on a call with one of our coaches. So we'll put all of those ways. If you want to go deeper, we'll put it in the email if that's all right. And we actually built some courses and stuff. We'll throw some discounts in there maybe to help out since people sat through this webinar and endured our slow talking.
Awesome. Well, same here. This webinar is recorded and we're going to share it with everyone and answer all the questions that we didn't reach to answer. And for everyone interested as well, Vyzer was built for tracking everything, including these private, more complex investments. And I love this work we're doing together to make it even better. And so feel free to reach out to any of us on our team, Joey and Russ also. We're going to share all their information as well after this with the recording. It was a pleasure. I appreciate it. Thank you everyone for coming out. And keep your passive investing passive, guys. We'll be in touch.